now going to look at exchange rates. Quite a lot of technical detail here, so hold on to your hat. So firstly, about how exchange rates are presented. And that's how you'll typically see them written. GSB. And that's how you'll typically see them written. GBP/USD equals 1.30. Now, if you've got an understanding of the sterling US dollar exchange rate, you'll know that that's £1 buys you $1.3. But if you don't know the two currencies, you might not just know that instinctively. So it's always the one that's written first, the GBP, that's the one currency, the fixed one, and the USD, the second one, is the variable currency. So that means £1 will buy you $1.30. Or the other way of thinking about it is it will cost you $1.30 to obtain £1. So here's a bit of a challenge for you. If pounds weaken, so sterling, GBP, what happens to the exchange rate? What will happen to those numbers? What will happen to the 1.3? Will it get bigger or smaller? Have a think about it. So my logic. So first thing to note is that the £1 remains as £1. That's a constant. That's called the base currency. The first one is the base or home currency. So that stays constant at 1. And it's the other number that changes, the 1.3. And that 1.3 will fall. And the reason that it falls is because the pound is weaker. So it'll cost us less dollars to obtain a pound, or £1 will buy me less dollars. Either way round works. So the exchange rate will move to something like £1 getting you $1.20. Well done if you got that right. If you got it the wrong way round, have another think about it and you'll get there in the end. Bit of terminology for you now. With exchange rates, if they talk about the spot rate, that means that's today's exchange rate. So if you want to exchange money today, that's what the rate that you'll get. You hand over your pounds, you'll get back dollars today. So you agree the price today and you settle it today. The forward rate, we agree on today, but we deliver the currency later. This is a bit like if you're going on holiday and you pre-order your currency to pick up in a couple of weeks' time. So the forward rate, you agree it today, but you settle it later. And so that rate will be based on the expectation of what the exchange rate will be when you collect the currency. For example, in 1 year's time. Now, something quite technical, so hold on here. Interest rate parity theory. And this is talking about why exchange rates move. So one reason exchange rates change is because our two currencies have different interest rates. So in the example we've been working through and using so far, £1 gets you $1.30, the spot rate, that's today's rate. If we're told that the interest rate is low in pounds and higher in dollars, so you earn more interest in dollars, if you had hot money, and what hot money means is money that you could move into different currencies across borders very easily, where would you choose to have it? Would you have it in pounds or would you have it in dollars? Have a think. If you have it in pounds, you'll earn 2% interest. But if you have it in dollars, you'll earn more interest. The rational investor with hot money will put their money into dollars rather than pounds because they'll earn more. Hopefully that's okay. So let's play that through then. So we'll put our money into dollars, and that interest rate I was talking about there was an annual interest rate. We can get that rate for a year. So we'll earn more interest for that year. And what that does today is mean that people buy dollars. That creates demand for dollars. They need dollars to be able to earn those 3% interests. And so that means that the dollar will strengthen today. That's because people are buying dollars to get the higher interest rate. Now, in our example, where the spot rate was £1 to $1.3, that factor is already included in today's spot rate because investors already know that they could be earning that extra interest. So that's already in today's, that's already factored in. But there is a second effect. Now, in a year's time, this is the effect on the forward rate. In 1 year's time, these investors with hot money are going to have a load of dollars that they don't really need. They don't particularly want dollars. They just went there to get the extra interest. So in a year's time, they're going to have a lot of dollars that they'll need to trade back into their home currency or into another currency to earn more interest. And so they will be selling their dollars in a year's time. What will that do to the exchange rate? Well, by selling dollars in a year's time, it creates supply of them. There's an excess of people trying to sell. And if you think about housing markets, when lots of people are trying to sell their houses, the house price falls, doesn't it? And it's the same with currencies. So if lots of people are trying to sell currency, it weakens. And so going forward, the dollar will weaken. Hopefully that makes sense. We're going to do some numbers with that now so you can see it in a bit more detail. And those numbers are going to be based around this horrible looking formula. So let's just explain what goes into this formula first of all. So FO means the forward rate. F stands for forward and 0 is today, the forward rate today. So the rate we can agree on today. SO is the spot rate today. So that's the rate we can agree on today to settle today. R is an interest rate. VAR, VAR, is not to do with football. That means the variable currency. So the interest rate in the variable currency is RVAR. And that, for our example, it's the one where the number moves up and down when the currency weakens and strengthens. So that's dollars for us, isn't it? And base is your fixed currency, your home currency, the one that stays as a constant one in the exchange rate. So going back to our original example and putting numbers in, we were told that the spot rate was £1 gets you $1.3. The sterling interest rate is 2%. Dollar interest rate is higher at 3%. And when we did our little bit of logic there, we decided we thought that the US dollar would weaken going forward because investors will have lots of dollars in a year's time that they'll be selling. Okay, let's stick these numbers in then and see if it works. So the spot rate was 1.30, so that's $1.3 for £1. The interest rate in the variable currency is dollars because that is the 1.3. That's the one that changes. So that is 3%, that goes on the top. And then the sterling rate, the fixed currency, the base currency goes on the bottom, 1.02. And that comes out at 1.3127. So did it work? We were expecting that the dollar would become weaker. Is that what we found? Yes, because now it costs me extra dollars to obtain a pound. It now costs me $1.3127 to obtain a pound. Or another way of thinking about it is that £1 now gets me more dollars. So the pound has become stronger, the dollar has become weaker. That's quite fiddly. It's a good idea to practice some of these calculations and also read through the logic slowly and carefully. Exchange rates, really easy to get tripped up on them. Let's now summarise what we've got over in this recording. We started with the more straightforward, comfortable stuff, things like changes in demand and changes in cost level. We then went on to the technical stuff, didn't we? Exchange rates, which look simple, but are really fiddly and easy to get the wrong way round. And particularly that interest rate parity theory stuff, very complicated. And we went through that example, didn't we, to bring interest rate parity theory to life. Hopefully that helped you to put it into context. I'd really recommend that you practice further questions in this area, though. Practice really does make perfect.